Hello, everyone. Welcome back to another Live with Caeli event. Today is Tuesday, July 5th. Hope everyone had a wonderful and safe Independence Day. As always, we're met with Caeli Ridge here live every Tuesday starting at 4:30 p.m. Eastern, 1:30 p.m. Pacific. And today's topics that Caeli is going to impress us with her unendless knowledge. It's all going to be about buying your next property, how to evaluate for long-term rentals, short-term rentals, appreciation to sell, the Burr method, and then we're going to go through property management. There's actually a property management questions checklist that we posted on the community a little while ago, earlier this year, and it got kind of buried into a thread. So we're going to repost that. With the recording. So welcome everyone, and welcome Caeli.
Thank you, Larry. Good afternoon, everybody. I hope you all had a restful and nice long weekend. Back in at it. I took a few days off last week, so I have been feverishly working to dig myself out of email hell. I think I came back to about 1,200 emails, and I had taken Thursday and Friday off. So I've been fixated on trying to get back into the living from that. So I'm a little distracted. Forgive me. Excited to be here with you as always and share whatever information we can to help you guys be more informed and arm you with just more information, right? The more information, the better. I think everybody agrees with that. So yeah, we're going to kind of dig into how to evaluate investment properties. It may not always be as obvious, and in some cases, maybe the way you're looking at something, there could be another way or another detail that you'd want to layer into it so that, again, your decisions are the most informed. So Larry, I think you said we're going to kind of talk about, I don't know if we'll have time to get to all of those topics, you guys, but anything we don't get to, we'll carry it on to next week.
Yeah, I think for those that are just joining, so part of this conversation had to do with, while Caeli was off, we got to go through and meet with some different clients. And one of the things that I asked Caeli earlier, which was the precipice of getting to this content for today's meeting, was all about when you're an investor and you're trying to sit there and you're trying to look for properties and you're trying to talk to Ridge about financing. We always value the relationship and helping you make your plan. But I asked Caeli, I'm like, Caeli, we go through this, and how would I really honestly evaluate? I found a property. Personally, as I've shared with others on the community, I don't really feel comfortable, having a plan for long-term rental. I'm really good at buying, renovating, and flipping. I'm really, really good at that. But maybe that's not a good strategy. So that's why I turned to Caeli, and I thought it'd be great for everybody to kind of learn along.
Yeah. So let's take them one at a time. Okay. Whether you're a short-term investor, right? You're doing the fix and flips, or you're doing short-term rental where it's a buy and hold, but for, vacation, Airbnb, or professional nurse, traveling nurses, whatever, or the traditional long-term ultimately dictates how you're going to review a property and what you're going to be looking for. And everybody's numbers are going to be different, right? Whatever your expectation is for your cash on cash returns and your ROIs, et cetera, all of that's going to vary depending on where you are, markets, all of it. I mean, just there's so many different variables. You can't account for the differences all across the country. So let's start with just the long term, just the straight, year, 2-year lease that you're going to buy this property. More often than not, you're going to be looking at a 30-year fix. That may be changing. We've been talking a lot about adjustable rate mortgages are coming back into play. They're becoming more mainstream. Anybody that's interested in digging into that, I'm happy to spend a few minutes again today talking about the 30-year versus the ARM. I know it's a real hot topic. Interest rates tend to be at the top of everybody's mind even still. So you guys let me know. Go ahead and put in the chat or unmute yourselves if you want to. So again, this is very subjective to who you are and what it is you're trying to get out of real estate investing. And then your goals change over time, and your qualifications also play a role here. But on a long-term investment, what are we looking for? You're looking for obviously the rate of return, making sure that the turnkey, if you're working with a turnkey, has appropriate property management. There's a whole thing. I think at the end of this, I think we'll wrap up with a property management conversation, because I was talking to my team this morning, and I would say to you guys, I don't know that there's anything more important in selecting an investment, real estate as an investment, than vetting that property manager. But we'll get back to that. Appreciation of the property itself, appreciation of the rents. What is the area dynamic, right? I don't know that you need, some people are going to go really, really deep dive on a long term, and they're going to look at the schools and the neighborhoods in and around. They're going to look at industry. Sometimes people follow Amazon or Nike or some of the big names, FedEx, right? And they're going to look to put, as they're opening up new warehouses and things, there are investors that will specifically follow these huge companies and decide that they want to find or buy rentals in that area to help supply for some of the worker base, right, as tenants. Let's see. So when I'm kind of trying to balance out my portfolio, and I think that's the big picture that I would want to impart, regardless of the investment strategy, long-term, short-term, fix and flip, whatever it is, I think a nice diverse portfolio is really where your eyes should be focused on, and having a good mix of that based on your aversion or your desire for more risk. All of these things need to be included. And whatever that says, maybe you want to have 70% of your portfolio for long-term and 30% for the shorter term vacation rentals. Maybe you want to have 50% single family and 50% 2 to 4 units. So those are some probably individual conversations that we want to have. But let me get back on topic. So long-term, and what do we really want to focus on? The rate of returns are changing, right? Real estate is cyclical. I think that if you're looking on just a long-term single family, let's just kind of focus on a single family so that we can kind of granulize this. I think that 8, 10, 12% right now ROI are probably pretty great numbers. You're going to find that in different markets, you have to account for a higher cash flow versus appreciation more often than not. Everybody's heard me say there's exceptions to every rule, but weigh that within the balancing of your acquisitions or refinancing or whatever it is. This property over here is going to cash flow really, really well, but you're not going to expect any appreciation. Okay, fine. I'm going to work over here and find some long-term rentals that I'm going to find more appreciation, and maybe there's no cash flow. Maybe there's zero cash flow. As long as you've got a great property manager and it's covering the rents, okay, fine. You're balancing it out. What am I forgetting? On the long-term rental, you also want to be looking at, I'm thinking, do we want to get into property management? Maybe I will save that for the end.
You want to save that for the end, then we can go through the
okay.
checklist. Yeah.
Okay. So short-term, this is more common. Anybody that's been investing for any period of time has probably started to notice that short-term rentals, while they've been around for a long time, they've just not been as prevalent. They're popping up everywhere. One of the things I'm really cautioning our clients about is make sure that in any particular area, you're looking at properties for that purpose, right? You've got your vacation rentals, you've done your math, it looks great, that the bylaws within the township or municipality, wherever it is, that they are allowing short-term rentals. I cannot tell you how many times I've had people come to me and say that they just purchased this property only to find out after the fact that they will not allow short-term rentals in this area. That's a big problem, right? If this is what your expectation was, and it's not going to be anywhere near that, will it cash flow on a long-term basis, or do you have to sell it, right? And maybe you have to eat the cost of the acquisition. One of the things, I was watching a video over the weekend, I think that when you guys are out there and investigating investments and how they're going to look within your portfolio, I would have lots of different exit strategies. I would be looking at any property and saying, how does it fit into this model? Long-term, how does it fit into this model? How does it fit into a fix and flip? And actually do the analysis in each direction. So that if for whatever reason, again, there's too many variables for us to try and account for today, or without an actual example, do I have all these backups? And if I don't, what is my real exit strategy if I needed one? Short-term rental, make sure that you know that it's available for that purpose in that area. Property management is a big one. I've been telling people that they're not as, property managers for the long term are much easier to identify and secure. On the short-term rental, I know that a lot of property managers are starting to ramp up so that they can facilitate. It's a much different animal, property managing for a short-term versus a long-term. The VRBOs and the Airbnbs, these are just they're websites, you guys, that you can highlight or showcase your property on. That's it. They're not going to do anything else for you. There's still all that management that needs to happen. Repair or the cleaning or the accounting. Vacasa, I believe, at least last I checked, does all of that. So if you, and they're nationwide. So Vacasa might be a good place to look for property management.
So Caeli, if we go back to long-term rental versus short-term rental, in your experience, when you're looking at a property, is it used to, at least from what I've always been taught, it used to be you didn't think about short-term rental unless it was in some type of meaningful area. Now, you mentioned earlier, maybe it's because of a certain company, or maybe it's in a resort area. But I've been seeing short-term rentals pop up almost anywhere. How do you try to figure out if a property is a good fit for one or the other?
Well, there should be some data. I mean, there's, Dear Google is going to be a great resource, but even if it's not going to be for the things that you mentioned, there are all kinds of traveling professionals, like I mentioned, whether it's nurses, whoever it is, that need, a crash pad for 2 nights or 3 nights or a week or a month, however long they've been commissioned to be in that area for work, for example. And actually, I'm finding a lot of investors are kind of leaning toward that model more than the vacation rental, because there's a lot less wear and tear, right? If you've got a professional, or let's say that another thing that I'm seeing quite a lot of is that if you've got a 4 or 5 bedroom home and you're using it for this purpose, you could theoretically, if it made sense, you could rent out all of the rooms to different traveling professionals, right? And increase cash flow even further. But anyway, I'm finding that a lot of investors are preferring that to the short-term vacation rentals because, right, there's just not going to be as much maintenance, as much turnover, and the wear and tear of the property is going to be a lot less if you've got, and there are sites that cater just to nurses or doctors or pilots or flight attendants, whatever, you guys, there's going to be lots of different professional industry that you could specifically, maybe you find your own unique niche and you market just to those in that area. So you want to do research about what is in and around the property, right? What kind of industry is there? Yeah. Does that answer the question, Larry?
Yeah, I think it does. Just as a follow-up, do you find that you use different math? You went through it just a short while ago, but obviously it feels like the amount of expenses that might be involved in a short-term versus a long-term are very different. And sometimes you can recoup those expenses for short-term easier than versus long-term. Do you agree with that?
I think that in general, okay, I'm a broken record sometimes. There's always exceptions to the rule. In general, you're going to find higher return on a short-term rental. If you found the right property in the right area, generally speaking, what we see is that, it can be exponentially greater in the return on a short-term rental. What are the pitfalls? I think it's a little early to tell. It's such a newer outlet for investors, especially for the traveling professionals. It's just not that it wasn't really done before. But overall, I do find that the short term the expenses cover themselves much quicker, and the margins between the expenses and the profit is quite a bit bigger.
Great. Okay, and for anyone, thank you very much, Caeli. And for anyone else, if you have any questions, feel free to take yourself off of mute and ask away. Or if you'd like me to ask your question for you, go ahead and just enter it in the chat. So we have a follow-up question. This is from Kate, Caeli. So Kate asks that they invest in long-term.
Oh,
only
I didn't finish my question.
Oh, you can.
on
There you go, Kate.
Hi,
yeah.
Kate.
Okay. All right.
Go
Hi.
for it.
Hi. I'm not new to listening to the podcast, but I'm new on actually coming on and getting a little bit more engaged.
Thank you for coming.
Welcome.
Yeah, thank you. Because I've liked what I've heard, and so, a couple of tricky things for us. We're older, And so our investments, we are dependent on as our income as we age, but we only started this in 2018. You know what I mean? It isn't like we're young people that can, and we already made a huge financial mistake. One, that's we learned 100 things from that. And we're not concerned with the interest rate. I know you should be, I know it has to be part of that valuation, but I know real estate from the 70s and the 80s, and the interest rates were way, that's why I put in, I think they were up to 11% in the 70s.
Yeah.
And
higher in the 80s.
Yeah. So I'm not afraid of that. That is part of how we do our numbers. But we're now considering going out of state. Our investments are in California, but we want to go out of state. But actually, my overall question may not have anything to do with today.
Okay.
But that is that if we don't have the bulk cash at this time, right? Like sort of what my parents used to call house rich, cash poor. If we don't have the bulk cash at this time, and we don't want to refi, are there lenders who will look at like some interests we own in a property and just our properties and just the value of the rents and the potential rents, and that's it? Can you get a loan that way?
So are we talking about, yes, it's called debt service coverage ratio, where we don't care about you and your income and your liabilities. We really care about the property. But Kate, you're talking about harvesting equity without refinancing, right?
Yeah.
So
yes.
Okay, so you're asking then if those debt service coverage ratio products are available for like a second lien mortgage or a HELOC in second lien position?
Yes.
I'm going to say not likely.
Okay.
Now that said, I would continue to check. I feel like PenFed is one of we don't do second lien anything. Everything we do is first lien. So if refinance is out of the question, I would say, let's look at your portfolio and make sure that is what makes sense or not. But check with the PenFed or Bank of the West and see if the second lien, I haven't gotten any mortgages from them. So I don't know how much scrutiny there is about debt to income ratio, individual debt to income ratio versus the property. There may be an option. And if you turn enough rocks over, Kate, you'll find somebody. That's, it's just not at the top of mind for me. There's got to be somebody out there that will do something second lien just on the basis of the property. There's got to be. It's out there somewhere.
Oh, okay. All right. That isn't, I'm just looking, I just wanted that question answered as to put in my pile of information that I've been gathering with your organization. So
I love it.
Yeah. And I haven't spoken to someone yet, but thanks so much.
You got
My
it.
pleasure.
Thank you for the question and welcome. We love hearing people listening to us and getting engaged. So you're always welcome to come. So as a continuation in our list, we talked about, Caeli, talked about long-term rentals, short-term rentals, appreciation may have been a great play exclusively for the last couple of years. How do you see appreciation getting into whether or not to evaluate, how to evaluate a property for the appreciation part?
So I hear and see a lot of publication and headlines, and depending on who you're subscribing to, the bottom's going to fall out, or they're still very, very bullish on real estate. I think that, first of all, be informed. Okay. Don't, if you're just exclusively listening to one publication, the good examples that are so dynamically different are Fox and CNN. Make sure that you find something in the middle to get some information about. Anybody, and I would share with you guys, anybody that makes a blanket statement that is in the entire United States has no idea what they're talking about. When we're talking about appreciation, okay, it's extremely subjective to the market. I think that in general, always exceptions to the rule. In general, I think we're going to start seeing values come down a little bit, which is healthy. We've been on an average of about 30% appreciation nationally, an average. For the last several years. That is not sustainable. Bad things will happen if we continue that trajectory. I do not believe that anything is going to fall through the bottom. I think that it's going to correct in a modest way. But if appreciation is really what you're focused on, the markets generally are going to be the Sunbelt states Okay, if you really want to focus on appreciation, the Sun Belt states, the Carolinas and Florida and Georgia and Texas, the West Coast, obviously. If you're going to be on the West Coast, I would prepare you to understand you're not going to be cash flowing probably more often than not, unless it is a short-term rental, more of a vacation rental, then that's a possibility, or maybe it's a 2 to 4 unit. But more often than not, the West Coast is not where you're going to get a lot of cash flow. You will find very good appreciation. I had a sales meeting this morning with my team, and I gave everybody a site to mess around with. And I would encourage you all to, maybe we can stick it in the chat, Larry, for everybody.
I'll actually put it in the show notes.
Okay.
For the FHFA, right?
Right, the FHFA.gov. This is the federal government. You know that they have access to all the data possible. So what you'll be able to do in here, they've got data tools, historical, present, and future of how different markets, and you should be able to find most markets in the US. And if it's not the exact market, you'll find something that's nearby, you know, within a 20-mile radius or something, that will show you appreciation values, past, present, and future. And it will help you make decisions on, you know, if that's your play, what to be looking for, what to be considering, and you can plug that into your valuation.
I know in the past, Caeli, you've had some opinions about Zillow or other websites that have kind of toyed around with their algorithms and predicting future models. You still feeling okay as far as using something like a Zillow forecast?
So we used to hate Zillow. I mean, it was the worst, and probably most of you listening probably know what I'm talking about. I'd say 5+ years ago. Gosh, I hope my timing is right. That'd be the last place I'd ever go to get a baseline for valuation. But whatever they've done over time, their algorithms that they've gotten, where that data is coming from, I don't know. The ones and zeros have really improved. So I think Zillow is a fine place to get a baseline. The more data you can collect, I think the better when you're trying to evaluate a property. So Redfin or Zillow, we have access to valuation reports. So if you send us an email with an address, we can get you some county records, property profile things that will tell us recent sales for like kind of properties that you can add to the mix. Check with your turnkey what comps they're using, right? They're probably using a multiple listing service, right? Get that. We want to jumble all that together and come up with a fair or an average baseline. You know, valuation is interesting. Everybody thinks that more often than not that the value of their property is going to be higher than sometimes it is, right? I'm not an appraiser, but I know enough in being in this space that if you think that the value just based on a Zillow search is going to be 200,000 and it comes in 150, you didn't do enough research. The other thing I would tell you, if you're going to go out there, and let's say that in your example, there's renovation being done, keep in mind that those algorithms that I'm talking about within whomever you're gathering the data from, they're not going to have access to a brand new kitchen or all new flooring, or you added, you know, they don't have that data yet. So you're going to have to account for that on your own, and how it's not usually dollar for dollar. If you put $50,000 into this property, doesn't necessarily mean that you're going to get exactly 50,000 more in value. It could be less or it could be more. It depends on the property and the market and inventory and all of those other variables.
Thank you, Caeli. As far as the looking at the comps, I know that Ridge has the property search that you just mentioned. So if anybody does have a property that you're thinking about, obviously we have some insights to try and assist you with that. So go ahead, and if you have an email of an address that you'd like to do a property search on, you can always email that to info@ridgelendinggroup.com. And one of the things that also comes up is, maybe a couple of months ago, you looked at the highest sale in the neighborhood because that was maybe a leading indicator. Do you feel that's still the case, Caeli? Do you think things have changed with the market?
Good question. I think that I would, especially depending on where you are in making decisions, or if it's for a purchase, you know, putting in an offer, I would not be looking at the highest listing or the highest sale of all in that area, in that demographic. Another thing we talked about earlier today, I would be looking at the average of what's being sold. It's probably a one-off. If you see one particular sold comp that is leaps and bounds ahead or higher in value than the rest, that would be a red flag. I would not be using that one to make any decision. There's probably a reason for, and again, too many variables to try and comment on, but that's
Okay.
not how you want to value.
Although I had no idea it was actually called BRRRR because I never kept them to go forward. But for those that are unindoctrinated, BRRRR, do you mind going into that and how that ties into a strategy?
Absolutely. So BRRRR, if you've been investing, you've at least heard the term, but for those of you that haven't, buy, rehab, rent, and refi, right? The Burr method. So more often than not, I find that people that are doing the Burr method, they're usually going to pay cash for a property. They're either getting an under market value or a distressed sale or something like that. So they're buying it for less than what it's really worth even then. Then they are going to put in a certain amount of extra capital in to, I don't know, if they're redoing the entire thing, or it's just kind of some lipstick, updating kitchens and cabinets and things like that, whatever it is, they're going to put a little extra in with the assumption, because they've done all this background valuation work, with the assumption that it's going to appraise for X. So easy math examples, they buy the property for $50,000, they put $25,000 into it. The expectation or the appraisal comes in at $100,000. The Burr method, if you've paid cash for the property, will allow us to do a cash out refinance up to 75% of the value, not of your acquisition cost. Now there's rules and restrictions here, guidelines and things that we can go over. If I can do that, maybe more on one-on-one. But if you're going to then do the cash out refinance, 75% of 100,000 is 75,000, and say closing costs are $5,000 of that, you're going to get back $70,000. You put in 75,000, you're going to get 70,000 back in my example. If you do that math, I think that the overall leverage ends up being what, 92%. That would be a very, very good investment. Anyway, that's Burr. Maybe more detail, Larry, do you think?
I don't think so. I think if anybody has any questions about BRRRR, we can go through it. I know that one of the things that has come up in previous conversations is planning for that refinance. In the past, Caeli, right, it would have been less stressful because you didn't really expect interest rates to be much different, 60, 90, 120 days later. Now it's got to be something you really need to plan for, don't you?
Yeah, I think that's a good point, Larry. And as investors, you probably were doing this prior to that, right? Just maybe not to this much of a margin or this much of a degree. But I would say that it's probably fair when you're doing your projections, if you're starting today, but you're not going to be getting financing for 30, 60, 90, add a half a point to the rate, maybe a full point, see what happens. Consider interest only, or an adjustable rate mortgage, right? Do your homework. Get your ducks in a row and make sure that you've got, like we started out talking about, you've got those different exit strategies or those different options. If this one just crumbles in front of you, you have backups that you can look at.
Caeli, do you want to, with the property management checklist, which primarily you'll find fits into long-term rental or even the BRRRR, right? That's about the time when you'll need to bring in a property manager from your experience?
Yes.
So do you want to go through those questions?
Yeah.
Do you want to just cover some of the lessons learned over the years? Because I'm sure you have a few lessons learned.
I may not go bullet for bullet, but guys, I'll just share my screen so you can kind of see what this is. Again, Larry's going to make it available to you within the community. So let's just take a peek at this.
And if anyone has any questions about this, again, feel free to take yourself off mute like Kate did, or if you want to put it in chat, I'll read the question for you.
So you guys should be seeing my screen. This is just a checklist. By no means is this complete, in no particular order. These are just some of the things that you want to have answers to as you're vetting your property manager. I'm going to go through these kind of quickly. If anything catches your eye that you want to dive deeper into, just let me know. Current vacancy rate. Ideally, you don't want a property manager that has more than 5% of a vacancy rate. You want to ask the same question, what's the average, right? If there's a big spread between those two, I'd have more questions to ask. How long are the average leases for the long-term buy and hold? 12 months, 24 months? What does that look like? The shorter term, that wouldn't be relevant, right? Well, actually, I'm now that I say that out loud, maybe even for the shorter term investments, the average length may not be a horrible thing to ask. It would probably speak to the area and the time in the year, right? Average length in the summer versus the winter versus the spring, et cetera. How long are they taking to get the property rented? Is it 2 weeks? Is it 2 months? Is it 10 days? How are they qualifying your renter? This is much more specifically about a long-term rental. However, some of you who have rented out from Airbnb or VRBO, I've noticed there have been a few occasions where the owner, the homeowner, is very particular on who he or she wants in there. So they will do some qualifying questions, and that may not be a bad thing depending on the property. Generally, higher end properties, you want to know a little bit more if you've got $1 million property that you're renting out, about who's going to be staying there, maybe a little bit more selective, not allowing, you know, a group of 18-year-olds to take the property for a weekend. Technology, what are they using? This should be top of the line. In 2022, you have to expect that in terms of tracking for the rents and the costs and all of the different things that go on, it should be total access 24/7. It should not be via email and PDF invoices and things. I would really insist on working with a property manager that they've got some kind of high-end technological portal for you and even the tenant. How are they marketing your properties for rent? I want specifics. Are they sticking a sign in the front lawn? What publications, newsletters, magazines? How are they getting your tenants in there? This is a good one. I mean, I'll just pick through a few more of these, and then you guys can see if you have any questions. Okay. So the tenant calls and needs. Now, this one is interesting to me because I've had situations like this myself. You know, your tenant is going to have issues. Okay. One that came to mind when I was writing this so many years ago was my tenant called the property manager and the disposal wasn't working. Well, they sent out the handyman immediately, and it was like a $90 charge. And guess what was wrong? You know, the little red button on the disposal that if you push it, it resets it. So if they could have the property manager could have taken a minute to just do that little bit of troubleshooting, I would have saved $90. So I know these seem like small, inconsequential things, but I promise you, you know, this is your money. You want to understand how the property manager is going to react when things like that come up. What are they going to do to ensure that you're keeping as much of your investment as possible? Let's see here. You definitely want them to be proficient in the laws of the state and even the county. I mean, it can change depending. So you really want to know, you know, what are the eviction laws if it came to that exactly, and then just feel confident that they know very, very, very clearly exactly what that means, the timelines, how long it takes to get someone out if you have to do that, what kind of notice before you can enter the property, all of that stuff. This is another good one, and then I think we can open up to questions. So I always set it so that, you know, if they have a need to spend X on Y, right? If it's $20 or $10, I don't have time for them to wait for me to answer a question like that. Go ahead. I usually say $200 or more. I want to know, and you have to get my approval before you can spend more than $200 on anything that may come up on the property. So make sure that you set that expectation up front. Yeah, you guys will have, I mean, you can read the rest of these on your own. I don't need to go through every single one of them probably. Anybody have any comments, questions?
I don't see any questions coming through on the chat yet. Anybody want to take themselves off mute? Maybe 1, 2, 3. No questions then. I think, Caeli, just as a summary to kind of go back to the different ways to evaluate. I know that you've stressed over and over over the previous meetings on this. You know, what works well for you? Kate talked a little bit about her experience and what didn't work well. In terms of moving forward, have you found from different folks that you've helped there at Ridge, are people reducing the amount of return that they're expecting out of their properties, or do you think it's just way too soon to tell that?
Say that again, Larry.
Yeah. So do you feel that, you know, between a long-term strategy or short-term strategy, with the markets changing, do you feel that investors are changing their rates of return from, you know, trying to hit a home run every time to now really going back to the way it was before the last couple of years where they're just good with singles or doubles?
Yeah, if they're not doing that, they should be, right? Remember this, like I said to start, this is cyclical, right? You cannot expect to have the same exact return as a static line, or right, a static line. It's going to change. So your expectations need to change too. And that's why I think that balance comment is so important. You want to be able to be prepared and have enough different eggs in different baskets that you can weather whatever comes at you. And real estate is diverse enough that you should absolutely be able to do that and be insulated from any kind of market correction, whatever that means.
Terrific. If anyone has any questions after today's event, always feel free to give Ridge Lending Group a call at 855-74-RIDGE. You can also visit the website, ridgelendinggroup.com. You can post any questions you want in the community as well, or send an email into info@ridgelendinggroup.com. Before we leave, again, one more sweep. I don't see any questions. Nobody's raising their hand. So Caeli, we want to thank you very much for another awesome Live with Caeli event on today.
Thank you, Larry. Guys, if your situation is individual, please feel free to call and get on the books with myself or another one of the dedicated loan specialists. And let's go through your particular ideals and goals and circumstances. That's really what I would advise. This is kind of an overview, but it is very specific to your needs and yeah. So that's what I would suggest. Do that.
Awesome. Thank you, Caeli. Look for the replay up in the community pretty soon, and everybody have a great rest of your day.
Thanks, Larry.
Bye now.